All right, y'all, what's up? This is Carter, and today we'll be talking about investing. In my last video, I talked a lot about businesses and how they get capital in financial markets. And today I'll be talking about the flip side of that, the actual investors that are giving these businesses capital in exchange for a return. So what is investing? Put simply, investing is allocating capital toward an asset in anticipation of receiving a return. And there are two kinds of assets. You have real assets, which are tangible assets, the kind of assets that a company owns, like land, patents, or a factory. And then you have financial assets. And these are assets that represent claims over real assets, so like stocks, bonds, or cash. So the relationship between these two, a company's real assets are what results in cash flows. I talked a lot about my lemonade stand last time. My lemonade stand has real assets like the actual lemonade itself, the lemonade stand, the labor that my brother provides. And if I was to sell stock for my lemonade stand, these real assets, the financial assets would derive value from the underlying performance of my company's real assets. The free cash flows that these real assets are generating are what is giving these financial assets value. So at its core, investing is all about risk and reward. Theoretically, the more risk an investor incurs, the more they should be compensated for that risk. So there really isn't a true risk-free asset, but the closest thing there really is the United States Treasury bill. It's kind of the closest thing to a risk-free investment because you kind of just have to trust the U.S. government is going to pay out all its debts. I think right now the yield on a U.S. Treasury bill is about 3%. So you can kind of look at that as kind of a benchmark for all other investments. If the risk-free investment is giving you 3% yield, everything else that's presumably is risky should be giving you more than that, depending on how risky it actually is. The riskiest investment I could think of was the lottery. I think I saw last week someone won like $1.2 billion from the lottery. Technically, you are investing $2 in exchange for this possible return. It's just super risky. It's like a 1 in trillion chance you'll actually receive any return. What a smart investor wants to do is find investments to provide a good return on a risk-adjusted basis. So the marginal risk that you are incurring above the risk-free rate, you want to be compensated more for that risk. So like a real-life example would be counting cards in blackjack. Mathematically, it's impossible if you go into a casino and play blackjack for a really long time to actually be able to beat the casino. But people that count cards, if you've seen the movie The Hangover or Rain Man, they can actually beat the casino through this method. This is really a good return on a risk-adjusted basis. They are receiving more of a return than the actual risk that they are incurring. So in the investing world, what we call this is alpha, these excess returns, above the actual risk that you are incurring. So there's kind of a risk-reward hierarchy with different asset classes. So obviously the safest asset class is like a U.S. Treasury bill, not going to be very risky, not very high reward. And as you move up, like a government, or a company bond or a company equity, you're receiving more return, but it's higher risk. And then at the top, you have options, which are very high risk, but also high reward if the underlying asset performs well. So capital structure, this is kind of how risk and reward plays out, within a company. So a company has a number of different stakeholders with different claims on the company's real assets. And each company has a different claim on the company's real assets with, different time and priority. So stakeholders that incur more risk will typically receive greater returns. So equity is probably the stakeholder that is incurring the most risk, but they also have the most upside if the company's real assets are performing well and generating a lot of cash flows. It's all about the cash flows. So, but if the company isn't doing well, like in the case of bankruptcy, so like Chapter 7 liquidation or reorganization, the stakeholders that incurred the least amount of risk will be paid out first. This is by law. It's called the absolute priority rule. So as you can see here, this is capital stack. It kind of shows priority on capital structure. So right here, you see senior debt. This is the least amount of risk, least amount of reward. And you move all the way up to common equity. So like a stock, highest amount of risk, highest amount of reward. So if the company performs badly and they have to liquidate, common equity, preferred equity, and mezzanine debt will not receive any return until senior debt is paid out in full. This is what the absolute priority rule means. Senior debt has to be paid out in full before any of these other stakeholders receive anything. So common equity most likely will not receive anything in the case of liquidation unless all of these other stakeholders are paid out in full. So this is kind of how risk and reward works. Equity is great until the company goes bankrupt and you've probably lost all of your investment and will receive no return. So now I'm going to talk about market exposure, which is also pretty important for overall investing. So market exposure is the proportion of one's assets that are tied up in a class of securities, a particular industry, or a geographic market. So someone that has high exposure is someone who invests in only oil companies in Houston. They're going to have a lot of exposure to the overall energy market and the Houston geographical area. You can see this is very high risk because if the Houston area, if there's like a hurricane or something, you're probably going to get all your investments wiped out. But it's also high reward if these assets perform well. But a lot of times people don't want to take on this risk, especially like a pension fund. They don't want to be so exposed to the Houston area. They don't want to lose all of their people, all their money. This isn't great. So they want to have diversification. And this is a collection of different investments that combine to reduce an investor's overall risk profile. A lot of these hedge funds, which is kind of why it's called hedge, they want to have an overall market neutral portfolio, which means they have little exposure to the overall stock market. So if the stock market goes up a lot, they're not going to really be affected. Also, if the stock market goes down a lot, they're not going to really be affected. So like a really good investing firm, when like COVID hit, they weren't affected that much. So all the people that invested in them, like a hedge fund, will still be okay. And they do this by adopting a long short investment strategy. So let me define what long short is. So what is short selling an asset? Well, first, if you believe the price of a financial asset will go up, it would be smart to invest money in this asset, obviously. And in this case, you were taking a long position, you are betting on it going up. But what if you think that a stock or other financial asset will go down? Well, obviously, if you own that asset, you should just sell it. But what if you just want to bet on it going down? You don't actually own it. Well, what you can do is you can just bet on the asset's price to go down through a short sell. So what are the mechanics of this? This doesn't really make sense. Like, how can I actually do this? Well, what you can do is borrow the shares of the stock that you want to short, sell those shares immediately on an open market for the price they're trading at, buy them back at some future point in time, pay interest to the person that you borrowed it from, and then return the share to them. So I'll show you how this kind of plays out in practice. So for instance, we have this stock called Carter. I think it's a great stock, but someone else might not think so. It's currently trading at $20, and I believe it will go down to $10. I must think that the cash flows that this business will produce are not as favorable as the overall market thinks. So I believe it's going to go down to $10, so I want to short sell. So I'm going to borrow the share from a brokerage, immediately sell it for $20, what's going on the market. Then once Carter goes down to $10, unfortunately, I'm going to buy the share back on the open market, and I can pay them back $1 in interest. And overall, I've profited $9. So this is great. I've bet on the company's stock to go down, and it did go down. So this is kind of how you can, adopt a short position. So like I said, someone that has a long short investment strategy, what they're going to do is they're going to long all the companies they think are going to do good and short enough to outweigh that, or to go along with that, so that they're market neutral, so that the overall direction of the market isn't going to affect the broader portfolio. And how we track what the market is doing is through a market index. So an index is a basket of publicly traded companies. So we have an index for various sectors as well as various economies. So some examples for the United States are the Dow Jones, S&P 500, and NASDAQ Composite. All of these are ways to track how the broader US stock market is doing. So now I'm going to talk about beta. So most individual stocks are somewhat correlated to how the broader stock market is doing. For instance, we saw this year when the Federal Reserve raised interest rates, that's basically going to make the present value of almost any company's cash flows go down. So as a result, the entire market is going to go down as a result of these rates. A lot of stocks, they're basically all correlated to the broader stock market. This is important. So a stock portfolio's beta shows its volatility in comparison to the market. A high beta stock, if the market goes up, it's going to go up by even more. But if the market goes down, it's going to go down by even more. So all stocks move somewhat, correlation to the overall market. This kind of shows how volatile they are in relation to the market. So just looking at a little example here, if the S&P 500, which is like the most common index to use to track the market, if it goes up by 5%, a stock with a beta of 1 should go up by 5%. A stock with a beta of 2 should go up by 10%. So as you can see here, more volatile, so more risk, but more reward if the stocks, if the overall US stock market goes up. So it's going up by 10%. Stock with a beta of 0.5, so less risk, you're only getting 2.5%. A stock with a beta of 0 is uncorrelated to the market. This is someone with a long short investment strategy. They would want to have a beta of 0 so that, how their portfolio is doing is uncorrelated to the overall market. And a stock with a negative beta actually moves in the opposite direction of the market. So I know it's like a popular thing to like buy gold because people think it moves in the opposite direction of the market. So it's good to kind of have as a hedge. But I don't really know of any actual companies that have a negative beta. It's kind of strange. It doesn't really happen that much in practice. But now I want to dive deeper into stocks. I talked a little bit last time about companies, and I kind of dived into stocks and how they derive value and how investors can make money off of them. But I'm going to talk more about them now. So first, I just want to say that the movements in a stock price are determined by supply and demand. So, obviously, if like a ton of people want to buy a stock and not many people want to sell, the price is going to shoot up. Opposite thing can happen. If a lot of people want to sell, not many people want to buy, then the price is going to go down. So what is determining the supply and demand? Well, it all has to come down to cash flows. Like I said last time, an equity holder derives value from a company's cash flows in the form of dividends or share buybacks, and also from capital gains. And capital gains, how, like a stock price is moving, like you get capital gains if the stock goes up. This should happen when the value of the company's future free cash flows increases. So it really all has to do with the underlying real assets that the company has and the cash flows that they're generating. But I didn't really define dividends and share buybacks last time. I mentioned them, but I didn't define them. So I'm going to do that now. So a dividend is basically a sum of money paid regularly by a company to its shareholders. So the important thing that people measure to show how much dividends a company is giving is dividend yield. Dividend yield is the percentage of a company's share price that it pays out in dividends each year. So for instance, Coca-Cola, popular dividend paying stock, pays $1.76 of dividends per share a year, and its shares trade at $63. So this is a dividend yield of 2.8%. Share buyback is when a public company uses cash to buy shares of its own stock on the open market. They're really, in essence, the same. Share buyback and a dividend. They're just a company, returning cash to shareholders. Share buybacks are better from a tax perspective, but some people argue that share buybacks are kind of just a way for a company to increase their EPS numbers. But I haven't really gotten into earnings per share, so I'm not really going to talk about this. All you really need to know is that share buybacks and dividends are both returning cash to shareholders. And, a company should really only do this if they believe they have no, good investment opportunities that can, produce ROIC above WACC. You don't know what that means, so I'm not going to get into that. I made an entire video about it when I talked about multiples, but I'll get into that later. So now I'm going to talk about the efficient market hypothesis. Is it possible to find attractive investments on a risk-adjusted basis? I would think if there were attractive investments on a risk-adjusted basis where I'm receiving more reward than the risk I am incurring, they would just be gone. There would just be none of those. That's kind of what the efficient market hypothesis states. They think it's impossible to find these attractive returns, investments on a risk-adjusted basis because asset prices reflect all available information. So we have the weak form efficiency of the efficient market hypothesis, which basically states that past performance of a stock is not indicative of future performance. We have semi-strong, which basically says that all public information is being priced into a stock. And then we have strong form, which basically says that all information, public and private, is being priced into a stock price. So they basically think there's no way to get this alpha or excess returns. Everything is already reflected into the stock market. But let it be known, this is highly controversial. Most investors don't actually agree with this. This is more of an academic thing because there's a lot of people in the stock market that aren't completely acting rationally. So it's kind of impossible for any, stock market to be completely efficient. But just to kind of understand what it means more, the weak form basically means that I cannot look at a stock's past performance to figure out what will happen in the future. The semi-strong form means I could spend the rest of my life looking at a company, what they do, all the public information, and I still wouldn't have any edge because it's all reflected in the stock price. I might think, Nike's a great company. I love their shoes, but all information has been priced into the stock about Nike's cash flows in the future. So there's just no way I'm going to be able to gain an edge. The strong form means even if I have insider information, even if I know things that are non-public, I will not have any edge. And people that think, the efficient market hypothesis is true, or even, people that think that like most regular people can't beat the market or find these alpha or excess returns, they think just buy an index. There's no reason to waste your time trying to find, the winners and the losers in the stock market. But, most investors, like, professional investors, like heavily disagree with the efficient market hypothesis. So now lastly, I'm going to talk about fundamental versus technical analysis. These are the two main investment strategies that people use. So fundamental analysis is a method of measuring a stock's intrinsic value and then comparing it to the current stock price. So I'm going to look at a company and, try to figure out what its future cash flows will be. And then I'm going to compare that and find out what I think the stock is actually worth. And then I'm going to compare that with the current stock price to make the decision if I should buy it, short sell it, or just stay away from the stock. Intrinsic value, like I said, it's the present value of the company's future free cash flows. And this would not be possible with the semi-strong or strong form of the efficient market hypothesis, because all fundamental analysis measuring the stock's intrinsic value, this would already be reflected in the stock's price. So it just would be impossible. This would be like a completely waste of time. Technical analysis, which is way less popular, is a method of identifying trading opportunities by looking at price trends and patterns seen on charts. So these are the people on social media that are like, oh, I can get rich quick day trading. They're like, I'm going to look at a chart, and if I see this weird shape, we should buy or sell. That's what technical analysis is. Some people will tell you oh, it's looking at the psychology of the market to gain returns. Well, most academic people and professional investors would disagree, and they just say it's not really real. But to each their own. And it would not be possible with the weak form of the efficient market hypothesis. And just a note that if you hear the terms growth and value investing, this is basically, it's the same as fundamental analysis. Both these are kind of under fundamental analysis, both different types of fundamental analysis. Fundamental analysis, it's what the intelligent investor, most professional investors teach. It's trying to project out the cash flows, figuring out what the company's worth, what the stock's worth, and comparing it with the current stock price to try to find attractive investment opportunities. So in conclusion, risk and reward, it's super important for investing. What we're trying to do is find good returns on a risk-adjusted basis. People that believe in the efficient market hypothesis, they don't believe this is possible. They believe asset prices, reflect all public, private information. However, most people believe this is not true. And if we're actually doing some deep analysis, fundamental analysis, we'll be able to find stocks that are mispriced. Mispriced meaning that their intrinsic value is different than the actual value that they're trading at. And risk and reward plays out in all different scenarios. Some investors want more risk, like a private equity firm, the investors there seek, 20% returns, where the investors in a treasury bill, they just want 3% yield. So all investors, have different, levels of risk they want to incur. And thus will get different returns. But you just need to know that risk and reward is very important to overall investing and really decides whether an investor wants to give their capital to a business. But I appreciate y'all watching this. The next one will be on the time value of money. So I look forward to making that one, and I'll see y'all later.